A first point that's interesting around Tesla is that it was never really a new science solution. It was actually more of an engineering solution. So, from a VC perspective, that means that you take a different type of tech risk. You take more of an engineering risk than a deep scientific fundamental question.
That's August Solliv, a former climate tech VC, author of the newsletter Impact Supporters, and currently doing strategic consulting for sustainability at Deloitte. In today's episode, August will walk us through the learnings from the first wave of clean tech startups and what it means for today's climate tech startups.
Cleantech 1.0 was primarily from 2006 to 2011. And the reason why you sort of stop it there is that clean tech investments pretty much died off after 2011.
And also what it means for venture capital.
A classic impact VC fund should in principle be aiming for the same returns as a totally traditional VC fund that's just doing normal tech.
Thank you to everyone listening to this episode, and don't forget to like, comment, and subscribe to the YouTube channel. Or if you're listening on Apple Podcasts or Spotify, don't forget to follow and give us a 5-star review. I think to get started on this episode, I need to ask you for a clarifying definition of, what is clean tech? What do we mean by Cleantech 1.0? Because that almost sounds like a passcode or something. Like, what is it exactly?
Yeah, well, that's it's the most important question, right? To begin with. So I think some people might be thinking, okay, we are looking at climate tech a lot today, and that's usually the term we use today. Cleantech 1.0 was a wave of sort of VC, primarily investments in the beginning of the 2000s, usually say from 2006 to 2011, focused in the US. It was a lot of investments primarily in energy. So it was manufacturing and new technologies in solar, wind, biofuels, and other types of fuels, often with very high upfront investments and quite unproven technologies at the time that the investors were looking at. And it was actually a sort of a reaction to both rising oil and gas prices at the time, as well as increasing amount of government subsidies as well in the beginning of the 2000s. And I guess a realization of a need to act on climate change that we also have today. And you could say some of the same patterns are actually reproducing today with climate tech. You have more subsidies, you have a clear realization that we needed. But I think the clear difference between back then and now, and sort of what we call Cleantech 1.0 and what climate tech is climate tech is probably broader. Clean tech was very energy focused, and it was a lot of the investments were these sort of high upfront investment, new technologies. And maybe to give a couple of just stats on what it was. From 2006 to 2011, there was $25 billion put into clean tech, which is quite a big number when you think about it back then. But compared to climate tech today is peanuts. And then just one more number is the year where there was the most investments in clean tech was in 2008. And there was $6 billion of investments.
And that's interesting because you're mentioning 2008, and if you've studied finance a little bit, 2008 is a period of a big crisis with the subprime and everything. I'm curious, did that have an impact on clean tech at all? Because obviously, I mean, the full story is like the financial market crashed, and there was a big kind of a bubble that was declining for housing in the US and a lot of things happening, but that had an impact on clean tech at all.
It's a good question, Hugo. And I think, first of all, I wasn't investing at the time, maybe good to say, and I'm not a historian, right? But I spent quite a bit of time looking at it. I think sort of one thing to think about when you think about the comp bubble and bust is that the IPO market kind of disappeared for years after that. And I also have another set of this is there's around 200 IPOs in 2007. I think it's 213, and there was only 30 in 2008. So you had a direct sort of a clear bust, right? And that also meant that if you were a clean tech sort of startup, like then it was extremely hard to either continue to raise because exit market seemed very complicated, or even just make your exit. So I think the exit environment for sure was very complicated. And then I think moreover, right, there was probably less and less LP money ready in those years. So also probably made it harder and harder to raise for cleantech startups. So definitely had an impact. It's always hard to say exactly how big it was and what it actually meant. But yeah, some effects.
No, for sure. And I think, for any businesses at the time, it was just a terrible period of time. Very hard to do anything in business, not a lot of money flowing around. But you mentioned already just earlier, like the type of areas. So you really said like energy was the biggest one. I'm curious, like, can you tell me a bit more about what this type of projects were? Is it just like solar energy? Like what are the type of stuff that we've seen at the time within Cleantech 1.0?
Yeah, I think that's a good point. I think there were a lot of different types of companies, and quite a bit failed. That's also why we talk about Cleantech 1.0, right? It's because in principle it failed on paper, and some succeeded, a few of them at least. So maybe a couple of examples of both failing and succeeding, and then we could jump into it a bit more. Right, on the failing side, you could have something like Solyndra, which was doing solar cells, but not focused on the same sort of what do you say, like not focused on silicon, but trying to use other rare materials to build these solar panels and do all the manufacturing. So that was one kind of company, but you also have, for example, Tesla that was started in the same number of years, and that is a bit different, right? More, I guess it's a car manufacturer by essence, but of course also sort of energy focused. And you had similar type of you had both battery storage, you had sort of swapping of batteries. You had different type of solutions, but a lot was energy focused, and also where sort of the investment were back then. And I think you can kind of see that same trend actually looking at climate tech today. If you look at sort of what industries are overfunded or underfunded in the current industry, and I can also send you a little graph that you can add to the show notes here if you want to, which is just energy is one of the overfunded sectors, and that sort of legacy. It's a legacy, would you say, a trend from back then, that energy was just sort of the major area that was invested in.
Yeah, that makes a lot of sense. And I think maybe the reason why energy is overfunded is also because that's the part probably where we can have the biggest impact. Obviously, we need to move away from fuel and, from coal and wood and all of that. So I think that might be also the place where, like, if we do well by transitioning to something more sustainable, we might have like a huge impact on, CO2 emissions and ultimately on climate change. I think the statistic I have in mind is that energy is about 25% of all emissions globally, somewhere in that range. So obviously that's why you want to focus on that sector first. You mentioned something about failure, and I have a statistic in mind. It came from the same study that you had, which is the MIT study from 2011, that says that nearly 90%, so 90, of Series A investment failed to return any capital, basically. So that, and I mean, obviously, startups are hard, and it's hard to go from Series A to B, but 90% is like super high. So I think that was a period of like large failure. Can you tell me more about the reasons why this startup fails? Because obviously, we'd already mentioned the context. At least the economical context was hard and was tough on startups, but is there something more to it than that?
Yeah, maybe not answering your question specifically first, but then going into it. So your question is why, right? But maybe just giving a couple of more sort of points on the sort of what happened, right? So I think first point is, I said before that investment or sort of Cleantech 1.0 was primarily from 2006 to 2011. And the reason why you sort of stop it there is that cleantech investments pretty much died off after 2011. So that's sort of the period that you should be looking at. And if you say usually why do investments in a specific sector die off? It's because they're not really succeeding. So I think the 90% rule, 90% number is very, very saying. But I think it's also important to say that if you compare it sort of with other returns in the same period of time, and for example, classical tech or med tech is what sort of this MIT study that you mentioned as well has looked at, then clean tech was pretty much underperforming on all parameters. They were the big money losers for VCs back then, and it was as we talked about, like startups developing new materials, energy focused hardware, some chemicals, and so on. And yeah, some of the biggest failures that you talk about for back then was Solyndra that I mentioned before, as well as some others that, for example, called Better Place that did battery swapping, Lightsail that did compressed air energy storage, so different types of solutions, but also linked to energy. So that was sort of the what. And you say why. I think there is maybe some macro perspectives that you could look at, and then we could also take maybe a specific case. So they're just going a little bit into that one because it was one of the big ones from back then that was a lot talked about. But yeah, so I think I have sort of noted, at least in my head, 4 reasons for why I failed. I think you can always, there's probably more, right, in reality. But if I should start with these at least, then I think sort of the first thing was that the financial crisis removed subsidies. So there's like an external environment that changed. So financial crisis removed subsidies. The oil prices actually declined again afterwards. So they had been rising. So therefore energy startups became interesting. Then the oil prices declined again. So making it harder for renewables to be cost competitive and efficient. And then sort of China also flooded the solar market. So that also meant that the price of energy declined. And when I say China flooded the solar market, was that they reduced costs majorly on solar panels, and therefore sort of you had development of new industries that started, and this sort of solar startups that have been built were struggling a lot to be cost competitive. So I think that's sort of an external environment factor. There's many things, subsidies and competitors that change a little bit.
And I think, just to cut you off there, because there's already a lot to say about these reasons. The first one about the oil price, we still today talk a lot about the green premium. And I think the green premium, just to define it, is the fact that people will pay more money for something that's more sustainable without getting something better as a product or service. And that's very interesting because the fact that the oil price went up and down actually had a big impact on startups, just because people look at startups for energy and they're like, oh, I can get the same energy for the same price, and on top of that, it's sustainable. I'll do it. But they don't look at it usually in the lens of like, okay, it's more sustainable. I'll do it no matter the price. So I think that's one of the good reasons. And then on the second thing that you said on the startups that failed, I think what's interesting there is that a lot of them were hardware startups, or we call them deep tech startups. So like those have large investments, large research and development cycles. It costs a lot of money. And I mean, to some extent, you could almost say that VCs were not used to this type of companies back then, because it was the era of the internet and the software, and everything was, very cheap to produce. So I think it also, makes a case for like, I don't know if VCs were really good at investing in clean tech. And I don't want to, talk badly about anyone there, but like, I don't know if people were prepared for this new type of startups. But can we continue on the specific example of Solyndra?
Yeah, for sure. Maybe if okay, I'll just jump on 2 points that you gave here quickly. So I think, yeah, for the second part of sort of the hardware, I think there's 2 parts in it, right? It's both that capital intensive hardware have risk, the ones that they invested in at least had poor economics that never really reached a scale where it was cost competitive, because hardware usually has a lower margin than software, and so cost competitiveness is different. And then, yeah, as you say, VCs were a little less probably used to doing hardware investment back then. That is changing, and in climate tech today, probably people are a little bit more used to it. But yeah, so there's definitely something to keep in mind there. And then maybe preempting a little bit our conversation, but I'm thinking now that you're talking about oil prices, we could just make a quick point here, which is that if you think about it, some of the sort of risks linked to oil prices are actually what we see again today now in Power to X, which is that Power-to-X is creating sustainable fuels. So it's a way to create sustainable fuels, but is not being scaled as quickly as many sort of analysts expected, because again, people are not ready to pay the green premium on these, and it's few sort of corporates that have put in demand for sustainable fuels, etc. So I think it's of the oil crisis and the energy prices really has a big impact on how you're able to bring sustainable solutions to market. But maybe, yeah, jumping to Solyndra as promised, right? And so let's go into the case a little bit. So as we said, they were a company that was producing solar panels. They were basing it not on silicon, but on copper and other rare materials. And the reason why they did this was because the price of silicon was growing and increasing to very unsustainable prices. So the solar market was becoming expensive. So what they were doing, they were saying, okay, there's a decreasing supply and increasing price of silicon, so we'll do a solution with other rare materials. They, in this period, in the Cleantech period, and a little bit before it, up until 2011, they raised around $1 billion US dollars of VC money, had around $500 million of government loans. So really reached a scale, had reached a unicorn status, if I'm not wrong. And sort of at the same time, then what happened was that China began to heavily invest in domestic solar panel production. So actually China went from, in 2006 to 2011, they went from having only 6% of global manufacturing of solar panels to 50% in 5 years, which is a crazy number when you think about it today, right? And completely changed the market.
On this one, that's interesting because I think China was probably the only country to be able to push a market like that. I think it's probably links to the politics of the country and how they manage things. But like, I don't think any country is capable of like flooding a market like that if there is not a government-backed approach where like, the government just says, hey, like we need to do more of this, and then we'll do more of this like at big scale. So I think it's interesting how China did it, but I'll let you continue.
Yeah, no, and I think also when you then look at what it meant was that the Chinese solar panels were pretty much 20% cheaper than all US alternatives. So a company like Solyndra, even though they had probably built on a trend which was sort of increasing price of silicon, reducing the supply, so therefore I really had a sort of competitive advantage based on that, ended up having to struggle against the price competitiveness of the Chinese products. And then sort of what happened more specifically for Solyndra as well was that then there was a sort of decline in the price of silicon afterwards. So it meant that sort of a lot of both Solyndra and also other solar innovators had a hard time to compete in the end, because silicon actually became sort of the main material that was used in solar panels for the years after. And then sort of what it has then meant afterwards, when you think about it, for the solar market, was that the prices of solar continued to go down, and you had more sort of, now today you have more widespread adoption. But it also sort of meant, which is a good thing, right? But it meant that for Solyndra and some of the VC investors in the solar industry back then, that it was not at all as sort of profitable as they had hoped. So I think that's the case of, again, sort of some external factors playing in. So if both a market price that changed and also competitors changing, and then I guess a sort of a VC bet on a technology that in the end was not maybe the one that was going to win, but you couldn't really know from the get-go, of course.
Yeah, and the interesting thing there is like when you tell that story, I mean, the thesis makes sense, right? Like you have a market, you want to change one of the component in the supply chain because there is like less supply for it. Like that makes sense, right? Like you would invest in it if you tell that story today. Like I would have invested in it probably. So that's very interesting how that went. But just to continue on that, I think the impact that a company like that, so you said 1 billion in VC funding, which is huge, right? That has an effect on the entire ecosystem. And I mean, today we can talk about Northvolt for climate tech. It's also pretty much a similar story where like a big company that was very well financed by VC also failed, that has a big impact on the market, because then people start to believe that it's not a good market to invest in, or it's not like a good idea to invest in this type of technologies. So other startups have a harder time to find funding, and that has like a huge impact on the ecosystem. But on the other side, what are the success stories that you've seen from Cleantech 1.0? Like, are there some good companies? I mean, you said Tesla already. That could be a great example, but is there anything else in your mind?
Yeah, no. So for sure, Northvolt is a very sort of recent, somehow similar example, but of course not, right? It's a different story. But maybe let's jump into that at the end as well. For sure, you're right. That's a good sort of, it's a good comparison also to in recent days and weeks and months. So we talked a little bit about like how climate tech might be dead and might not exist going forward. So I think that's a good example. But maybe putting on the historian hat a little bit again, looking at the success stories. I think one interesting point that is not a specific case first, but I think is worth noting is that John Doerr, the chairman of China Perkins, he has actually went out after the whole Cleantech 1.0 period, actually I think around 14, 15 years after, he went out and said if he actually looked at his returns from back then, like the companies he invested in, and looking at the returns 14 years after, he actually 3x'd his investment. So he had invested $1 billion back then, and that was worth $3 billion 14 years after. So quite surprising number actually, meaning that there was definitely some value that was created in those years, and that sort of meant that some investors could be able to make a fairly profitable case.
And I mean, Tesla alone could have returned almost all of that fund. Like if you invested very early in Tesla and hold on to it to today, I think you could have almost returned the entire 3x. But
100%, I think you could do more, right? It's, I think, I don't have the exact number, but I think if you invested in Tesla back then, right, it would probably be more like 100x or more in that period. But I think, I guess when you think about it, it poses the question of should you have a longer holding period, for example, in climate tech to be able to accommodate to that sort of longer time to make returns. But at the same time, it's not really VC returns, right? If you only get a 3x in 14 years, that's not what you're looking for. But I think it's at least it's an interesting question about sort of value being created and whether there was actually success again. But maybe let's jump to Tesla, right? Because I think what's interesting about Tesla is sort of the success they had based on where they started and what they created, and also what led to this. Of course, Tesla is many people have talked about Tesla. It's hard to say what exactly made Tesla successful, but I think what's a first point that's interesting around Tesla is that it was never really a new science solution. It was actually more of an engineering solution. So, from a VC perspective, that means that you take a different type of tech risk. You take more of like an engineering risk than a deep scientific fundamental question risk. And what I'm meaning here is that Tesla was actually what they did was that they were stringing a lot of batteries together. I think it's around 7,000 batteries together in a series, and sort of compartmentalizing them and making sure that if one fails, the other one runs, etc. So they actually put these batteries together and they made a car run on the battery. So it's not a new type of battery. And that meant that the sort of from a VC perspective, it means that the technological risk is very, very different. And I think some VCs have sort of reacted on that after. An example is Bessemer, that actually has also made a guide of sort of how they reacted to Cleantech 1.0. And what they went out and said is that they primarily, of course it's always primarily, but don't invest in scientific research, which they think should rather be sort of invested in and backed by governments and research institutions. But instead they focus more on these sort of engineering questions. So I think that's at least the first point about Tesla that's quite interesting. But of course it's not a recipe for success, because there was also other companies at the same time that were also looking at EVs, electrical vehicles, that it stands for, and also tried to do more of an engineering solution, but that didn't succeed, right? But at least it's an interesting case. And I think something else that's also interesting about Tesla was that it was actually built by people they were fairly unknown in sort of the automotive industry. So Elon Musk wasn't the founder, but he was an early investor and then became CEO after. But the sort of the founders, they had actually they were competing against people that had been in the automotive industries for years, and they were famous in the automotive industry. But they kind of came with this a bit more innovative souls potentially, and sort of and that's how they changed the market. So I think there's like the learning from that is probably maybe engineering is one better way to invest in climate. It's an open question, and then it's also maybe you shouldn't be going for the incumbents or the people that seem like they have stayed in the industry for many years, but rather go for the ones that are challenging it a little bit. Yeah, some of the learnings at least.
Yeah, for sure. And I think on that first point about engineering versus science, you have a lot of impact VCs today that invest at specific stage of what they call technology level readiness, which is basically assessing where are you from like this product is in the lab and we're trying to understand the question and whether it could potentially work in the future, like really hypothetical, versus the other end of the scale, which is like, okay, this product is in market and science works and we can now have customer and we can deploy at scale, right? I think a lot of VCs today choose to invest anywhere in the middle, which is like you already have a proof that the science works. The question now becomes how do you scale, which I think VCs are specifically good at doing or advising company to scale. And then the second point about whether or not you should have someone from the industry, it's very much an open question for sure. But if you take the example of like all of the other car makers, they completely missed out on the electric opportunity because they had already something that was profitable and nothing was pushing them to actually move to electrical until Tesla did. And then now obviously they're all trying to catch up. So I don't know really if you need someone from the industry or not. It's probably helpful, but I think not the entire team should be from that specific industry that you're trying to disrupt. Or at least that would be my take. But
it's a hard one, right? Because at the same time, you probably also like the industry expertise, and I'm sure there's a lot of VCs that also prefer to invest in industry experts. But I agree, it's at least an open question of and sort of an interesting one when you're looking at a deal. Which way should you go?
Yeah, for sure. But so 2011 investment completely stops in Cleantech 1.0. We don't talk about it anymore, and then slowly but surely emerges a new movement, which we call climate tech. What is the start of climate tech? When does it start? Who starts it? Like how does that come together?
Yeah, that's also a very good question. And I think there's a less clear definition because sort of these definitions usually are made sort of when you look back in time, right? Saying, okay, it started this year and it stopped around here because maybe funding stopped, etc. And I think if you have to sort of look at it, climate tech probably started around the end of the 2010s, beginning of the 2020s, depending on sort of where you set the mark of where the sort of the climate tech really scaled and when the new funds, etc., were raised. And again, and also to your question of who started it, it's also probably it's a hard question to answer when you look at it from like a fund perspective. You have some impact funds that were actually already started back in the beginning of the 2010s, but they were usually more socially focused, and then they transitioned slowly into becoming more climate focused. Same with sort of, you have quite a bit of generalist investors that have transitioned into either having a climate sector focus or having it as one of their funds, etc. So it's hard to say it was this fund or this time that it was set. So I would probably actually wait a little bit of time to be able to say that. Maybe in 10 years we can say more specifically. But yeah, end of 2010 is probably the most correct answer.
And what's different then? Because if you climate tech, clean tech, like is that a label? Is there something different in the approach, in the technology, in the startups that we find? Like what's different?
It's also a very good question here, bro. And I think maybe some things are similar, some things are different. I think one of the first things that is really different is sort of the emerging opportunities that we see in climate tech compared to Cleantech 1.0. As I mentioned, a lot was focused on the energy sector before, so solar energy, biofuels, and sort of linked to the oil prices back then. I think in contrast of climate tech, or what some people call climate tech 2.0, sort of in reference to Cleantech 1.0, that stands a bit quite a lot broader, right? So it's all industries that need either sort of decarbonization, so it could be both mitigation of climate issues, and I was saying decarbonization, but of course it's broader, biodiversity, etc. But also adaptation to some of the sort of changes that climate change brings. And so here I'm thinking it could be transportation, it could be agriculture, industry, construction, etc. in reality. So therefore the opportunities and the solutions in the space are quite different. Then I think from another more sort of result-specific one is that climate tech has already proven that startups can reach more successful exits than probably Cleantech 1.0 did, or at least there's a bigger sort of willingness from corporates to invest, which there wasn't back then. So you said back then we had an exit market where IPOs were failing because of the .com bubble. You didn't have corporates that were really investing in climate tech. So that has changed, which is a positive thing for VC investors because they're more certain about their exits, even though the IPO market for climate tech is not doing great, if we have to be 100% honest. Then I think from an investor perspective also, you have VCs are a bit more adapted probably to climate tech now. Of course, I wasn't an investor back then, so it's hard to say specifically, but there's a bit more of like, okay, we hire a scientist as well in our VC team, and we look more at sort of TRLs that we mentioned before, Hugo, to be able to assess where the startup is on their tech journey as well. And there's more sort of mature tech infrastructure around the innovation, so we have more data infrastructure, more AI infrastructure, etc., that sort of helps the startups and the investors in this space. So I think there's different things, but maybe if I should mention one more thing that's really different is also sort of the opportunities we have today with enabling hardware through software. So 10, 15 years ago, you maybe had a little bit of IoT, Internet of Things, so sort of connected devices, but not at all to the scale we have today. You didn't have a lot of sort of AI solutions. You didn't have a lot of data readily available from big corporates, from smaller companies as well, from buildings, etc. And so that sort of supercharges the existing trends that you see in climate and just makes everything work a lot quicker. And also, and when we say things work a lot quicker, that's very beneficial from a VC case, right? Because what you're looking for as a VC is quick returns, quick development of these startups. But I think that climate tech is not sort of destined to succeed either, right? If you look at it, climate tech also have quite a lot of similarities with Cleantech 1.0. When people were investing during the Cleantech 1.0 period, they were seeing it as a huge trend, probably a mega trend that was larger than anything we could imagine today. And that's also what we're saying today, right? We're saying climate is a huge trend within VC, a huge area for investment opportunities. And the differences are there. Maybe you have subsidies that are different. Maybe you have an energy price sort of that is different. You have infrastructure that's different, but we cannot for certain say that it will actually be way more successful than it was 20 years ago.
Yeah, I agree with you. I don't know that we can say it. And I also think that what's interesting there is like it's a bit of a labeling of a period of time, because conceptually we're thinking about the same idea, which is like what are the startups and innovations we need to solve for some of the problem for climate change. But it's just like a different period of time with different type of investors, different type of startups, different type of technology as well. Just to echo what you said on corporates, I think that's very interesting because a lot of companies today are trying to do more with less, and be better at managing their sustainability components. So I think that's very interesting, and that pushes obviously the demand for startups in that space. You have also another component that you didn't mention, but I think it's very important, is that talent. and people want to work for companies that make sense and want to work for companies that have a positive impact on the world. And I think if you have great talents that wants to work for this type of companies, obviously, then you push the performance of the company super high. And something else I think you didn't mention, but I want to pick your brain on that, is like on the funding model for venture capital. Do you see something new? Because I start to see more what they call evergreen funds, which are like don't really have necessarily like an investment period locked up and a return period locked up already ahead of time. Like they're more like having like patient capital, they call it. So like they're willing to wait a bit longer. Like, what's your perspective on that?
It's a trend that's definitely coming. I think evergreen model is the primary trend I'm seeing. That's sort of how people try to change the traditional VC model to adapt it a little bit more to climate tech. It's not a trend that I would say a lot of investors have jumped on. And I actually think there's multiple reasons why. I think one is maybe probably a belief that holding period should be the same, because if you want sort of VC economics at the end, then you also need fairly quick returns. So therefore, an evergreen fund and sort of changing holding periods is a risk, added risk to a fund. So that's definitely one. But I think the biggest one when I'm talking to VCs is that in reality, people, or sort of a VC needs to raise a fund from an LP. LPs are not used, and LPs being limited partners, so they could be pension funds, high net worth individuals, etc. So the ones sitting on the capital and the money in the end. And these LPs are not used to investing in evergreen funds, and therefore building an evergreen fund is just sort of adding risk and making it more complicated for you to raise your funds. So therefore, I would say it's fairly limited, the number of people that try and go in and build complete different models in climate tech VC. And I think other ways that people try to do it is to have like an internal science team, for example, is also a different way of trying to adapt your VC model to be a little more climate focused. But that's also only a few that are really doing that. So I would say it's often both because either you don't believe in sort of the idea behind it, the holding period should maybe be longer, or that you're actually not able to raise one because of LPs and the way the capitalist system is not built or is not used to, at least, give to hand out LP money in that way for that type of funds.
Yeah. Yeah. It's interesting because obviously you need LP to be aligned with what you're doing. And I mean, obviously you need LP to contribute because otherwise VCs are nothing without the LPs, right? So it's an interesting model that I don't know if it will work. I'm actually going to have someone in the podcast that's from one of these funds. So I'm excited to deep dive a little more in that topic. But coming back to like, I think something that's in my mind right now is like, you mentioned already the return from that one fund that I can't remember. I think it was Kleiner Perkins that did 3x on Cleantech, basically. I think a trend I see emerging right now in climate tech is that a lot of VCs either come from the traditional VC world, and so they've already seen what it takes to like build a VC fund that works and VC's economics that works. And I also see a lot of them actually saying out loud, like, we will return at least the same, if not more, than your traditional VC firm. Is that something you see as a trend, and do you believe in that?
I think maybe taking it from the impact angle, you talk about two types of impact funds, and climate tech is a type of impact fund. So it's a classic impact VC, and then you have a sort of an impact first VC. And the difference here is that if you're impact first, you're aiming for sort of lower than market rate returns. So you're sort of accepting that, okay, if I'm investing in impact, I will get a little bit lower returns. A classic impact VC fund should in principle be aiming for the same returns as a totally traditional VC fund that's just doing normal tech. I think if you look at returns until now, first of all, you don't have realized climate tech funds, because as we talked about, it was end of 2010s that they really started to sort of proliferate, and therefore you you don't have had any, or you haven't had any yet that have really been realized. If you compare them, you have some. If you actually, I have only one real impact fund to my knowledge that has been realized, and that's Ananda's first fund, which was a social impact fund with few startups in it. So it's also not comparable. But talking to LPs that I invested in quite a bunch of climate tech VCs, then I would say it actually depends a lot on the fund, what the returns look like so far. So some LPs say that they have funds where they are sort of outcompeting the traditional VC market, and some LPs say that they have funds that are not doing it. So I would actually stop it right there and say it's a little bit still of an open question, but trends are sort of small nuggets of knowledge so far are showing that results are maybe on par, maybe a little bit below, maybe a little bit above, but that's a big question mark for now.
Big question mark, but at least on my side, I have huge belief that it will outperform other funds. And I hope so, because if yes, then we'll get more money into this type of funds and we'll probably have better impact for the planet, and we'll probably have like somehow like a livable future, or something that looks like, pretty much similar to what we have today. And that's something that's, a world that's totally broken with like a lot of extreme weather event and whatnot. I think we need to close off this section on climate tech onto one more thing, which is we start to hear nowadays, in late 2024, the term like climate tech is dead, like climate tech doesn't exist anymore. And it's been a growing trend on social media, and, TechCrunch have written articles about it, and like a lot of different media have talked about it. Why is that? And maybe what's your take on this one?
Yeah, Hugo, I to be honest, I was a little bit in doubt in the beginning what it actually meant when people started talking about it, right? I think it started from one tweet, and then it sort of became a thing over the last months and weeks, as you said. So the way I'm seeing it now is that there's sort of two parts to it. The first is that you definitely have had some bankruptcies or failures in the VC world in recent weeks and months that have meant that it doesn't look as attractive as it used to be, sort of climate tech as a whole. So the main one being Northvolt, a unicorn in the climate tech space that just went from being sort of one of the big successes in climate tech to a failure, and that's rough, of course, on the industry, and makes it less interesting. And I think with that also comes that sort of LPs are also starting to look a little bit away from climate tech. I think there was a big hype in the last years. It's not as big anymore. There's also hype moving a little bit towards, I guess, AI being the big one, and then also a lot of defense and space tech is also getting there. So I think sort of so the fact that there's some bankruptcies and some failures, as well as LP money going away, means that from a financial perspective, there's a little bit of an open question of how long does climate tech continue? What does it become? An open question. So I think that's the one part. I mean, the other point I want to make is that I think there's also been a discussion about whether the term even really makes sense, right? Should climate tech, first of all, be in like a sectorial focus for a fund, or should novel VC funds just see it as like a novel tech investment? That's one question. There's also a question about, does climate sound too much like it's only related to CO2, or is it also overconsumption, biodiversity loss, sort of climate adaptation a bit larger? It doesn't really encapsulate everything. So I think there's a sort of a framing question, which is the second one, and then there's a sort of an economics question of whether climate tech really will succeed. That's also an open one. So I think that is just the reality we are right now. I don't think climate tech will disappear right now. So maybe the term climate tech is dead is a little bit of an over exaggeration. But the question is, can sort of funding sort of take a new uptake? What are the next trends? What are the next frontiers in climate tech is a question. But yeah, I don't know what you've been thinking about the whole last month, Hugo, and climate tech is dead concept.
Yeah, I think it's just like, I just think it went viral, and then, as you said, like there are some factors like the bankruptcy of Northvolt, for example, made a lot of noise. I think if I recall correctly, they got 15 billion in funding. I think that's the amount I have in mind. I have to double check this one, but I think that's the order of magnitude that I'm talking about. So obviously that has a big impact. No, I don't know. I just think that climate tech is in itself, like the logic of it will continue despite whatever label we put on it. That's my take on it, which is basically say we need startups that are working on real important technology solutions that will solve for climate change and for biodiversity and all of the other impact spaces that we have. So no matter the label we put on it, and I would be happy that standard VC fund actually invest more into this type of companies because they are better in terms of return and because their economical model makes sense and their unit economics make sense, right? So I think it's just like a labeling situation more than anything else. I think the logic of it will remain no matter what. We are getting toward the end of this episode, and I have a quick section for you. I didn't prepare you for this one on purpose. This section is a fire question, so you'll have 1 or 2 sentences to answer all of these questions, and we'll try to cover approximately 10 of them within the next 5 minutes. Are you ready?
Yeah, so nice. Super excited.
So what would be one technology that you would bet on in 2025 in climate?
I guess the easy answer is probably AI, right? Sort of some mix of AI and climate tech. Another quick answer would probably be something related to power to X because it has seen a decline, but might take an uptake again soon.
Interesting. And what do you think the role of AI will be in fighting climate change?
I think, as I mentioned quickly before, I think it's sort of an enabler that supercharges things. So I think it's supercharging how hardware gets used. I think it's supercharging some of the software we're developing. So it's even more sort of an enabler in the space than a specific sort of solution.
Yeah. You've been a VC before, so I can ask a question more related to that part of climate. What is a green flag when you look at a climate tech startup? What is something that when you were doing that job, you thought, I want to invest in that company?
It's funny. I actually usually think about it more of a red flag. What turns you away from a deal? Because coming into a deal, I would always say, "Oh, this is fairly a green flag," and then I start looking at all the things. And when I get red flags, I stop looking. Right. But a green flag for me would be sort of mission-driven founders, actually. So the people that really do it because they care about climate, because then you're first of all aligned with them, and also you see the same sort of $1 trillion opportunity around climate, etc.
And so what would be the red flags then?
I guess the opposite would be just saying someone who's not climate aligned. But I think a red flag would be hardware startups that don't understand the economics, because the economics in reality are so different than hardware from software, and therefore for the VC model, the economics just look very different.
Yeah, I love that. Do you think impact VCs will outperform traditional VCs in the coming years?
I can only echo you on that one, Hugo. For me, it's $1 trillion opportunity. We know that we have a huge funding gap, so definitely believe that there will be some sort of outperformance. Question is how much and what performance it will look like, and I think it depends a lot more on how investors actually invest reasonably and avoid taking like science risk and avoid taking a philanthropy role that they shouldn't have.
Yeah, for sure. What's one thing people get wrong about climate tech in general?
That's a tough one. I think actually I have an interesting take, which is not 100% answering your question, but I think a lot of people talk about climate tech from like as an overarching concept that if you're a climate tech VC, you just do everything in climate. I think there's more and more specialized funds in climate that I think are very interesting. So like an agricultural climate fund or a fashion climate fund, for example. So I think that's where sort of some of the nuggets are coming in the future, and where climate is interesting and sometimes misinterpreted.
I love that. Do you think there's still hope that we stay below the 1.5 degrees from the Paris Agreement?
That's a huge macroeconomic question. I think I prefer not to answer that one, but probably the answer is no.
Interesting. And what's one idea, and that's going to be my last question. What's one idea that you would love to see funded, or like something that you had in mind and you wish you could find a startup to invest into?
It's not going to be a specific idea, but I think the water tech space is what I'm looking at quite a lot right now. So finding some things in water, because it's an issue we don't see as much in Europe as in the rest of the world. But I think at some point we're going to see it in Europe, and we need also solutions first in the rest of the world before we find them in Europe and at Denmark where I'm sitting right now.
Yeah, that's very interesting. I agree with you. Like, we are not so concerned right now, but it will be more and more of a concern in the future. Well, look, it was a very interesting episode. I learned a lot from you today, and I think this history of clean tech to climate tech to maybe something else in 2025, who knows, is very interesting. Is there one book, one podcast, one resource that you would like to give people to deep dive more in the topic?
I mean, for sure, listen more to your podcast, Hugo, and probably also read my newsletter and soon to be podcast would also be a recommendation. But I think if we don't promo ourselves, then I think the answer would probably be, if you're looking at more Cleantech 1.0 specific historical knowledge, then look at the MIT study behind this. I think it's around 30 pages, very understandable, but very much in depth as well. So yeah, I think that would be my recommendation on the Cleantech 1.0 at least.
Yeah, definitely. And I'll put the link to that in the show note. I will also put the link to your newsletter and to your LinkedIn profile. I think that's where people can find you online. If you like this episode and if you like the show, don't forget to like, comment, and subscribe if you're on YouTube, or if you're on Spotify or Apple Podcast, give us a 5-star review. August, one last question for you. Who's the next impact VC I should interview?
Good question. I think actually I was going to recommend the second book. So I like to take the one he's not a direct impact VC, but it's Sir Ronald Cohen. He's the founding father of impact investing, and started a private equity fund and impact investment firm afterwards. And a second book recommendation is this book called Impacts, which is about impact investments. So more for the investment side. So I would guess him on.
Love that. Thank you so much. I had such a good time today. Thank you so much, August.
Thank you. Thank you for the invite. It was amazing.